Target's out with better than expected fourth quarter results this morning. Came in with earnings of $2.98 a share. That was much better than the $2.42 the street was expecting. Revenue also beat expectations, coming in at $31.92 billion versus the $31.8 billion that had been expected. And joining us right now for an exclusive interview is Brian Cornell. He's Target's chairman and CEO. That stock, by the way, up by about 7.6% so far this morning. And Brian, thank you for joining us.
Great to be here.
So a lot of things to move through just on the quarter that you just ended, the year you just ended, before we get to your guidance for the next year. I think the thing that jumped out at me the most was how operating margins improved. That was a big deal. What happened?
Well, I think it was a really solid full year. I mean, you reported it, you and Joe have been talking about it, but to see our op profit grow by almost $2 billion, EPS year on year up almost 50%, really solid progress from an inventory management standpoint. We've been talking about efficiency work within the organization. Of the almost $2 billion in profit improvement, about $500 million came from operational efficiencies that we are continuing to focus in on.
Like what? What did you do differently?
Inventory management played a big part in it, in greater productivity upstream in supply chain, in stores. So the team's really focused on managing cost. And we did see sequential improvement from the second quarter to the third quarter to the fourth quarter, really led by a big improvement in traffic. But if you decide to join us later today, and we're right down the street having our annual investor conference, you'll hear me talk about the fact that we're not satisfied with where we are. And our theme today is all about a roadmap for growth, getting back to growing the top line, growing traffic, and making sure that we make Target a growth company again.
How do you do that for the year? We did talk a little bit about the full year. You're looking for comps to be flat to up 2%, which is about what the street was expecting. Adjusted earnings per share, $8.60 to $9.60. The street was at $9.10, or was at $9.15. That's right around the midpoint. But for the first quarter, you are looking for earnings per share to be probably below what the street was expecting. Comps down 3 to 5%, earnings per share 170 to 210. So what's happening in the current quarter, and how do you expect to change that through the rest of the year?
Becky, we've been working across the organization on some great plans to stimulate traffic, drive comp growth across our business. We certainly expect to see improvement in our overall company performance. And we're putting a lot of time into ensuring we have the right balance of newness and value across our portfolio, whether you're shopping in our stores or online. And I think as we look at the current state of the consumer, we know they're shopping at that intersection between newness and value.
So
and we'll be focused throughout the year.
The consumer is still looking at value propositions. You're looking at a consumer that's a little pinched coming in?
Well, I think as we think about the consumer, and I've heard, Joe, you talk about this, Becky talk about it for years now. I think we've seen a very resilient U.S. consumer. Despite inflationary headwinds, rising interest rates, the uncertainty of the market overall, the consumer continues to shop. You know, on a full year basis, we generated $107 billion in sales. And a big part of that came from discretionary categories. So it's a consumer who's on a budget. They're shopping carefully. They're still looking for newness. They're still looking for value. They're celebrating seasons. So we expect that to continue in 2024.
Right, Brian, the inventory issues were a couple of years ago. I mean, you've been dealing with them now for a couple of years, but the stock bottomed in like October, November at like 102. I'm wondering what that last move from 150 to 102, that wasn't inventory anymore. That was macro recession worries, it looks like to me, because a lot of your peers, the stock charts look almost, that really doesn't show it. Make like a 1 year chart. Was that what it was, that we were all waiting for Godot last year for a recession?
Well, I think many in retail face some inventory challenges coming out of the pandemic. Yeah. And certainly, Joe, there's been some concerns about discretionary spending in categories like apparel, in home, in toys. And we certainly have seen some of that over 2023. We expect some improvement as we go into 2024. And a big part of that's going to be the work we do with our national brand partners, with our own brands, with our great partnerships to make sure we have the right balance of newness and value in our offering.
When you talk about the efficiencies you get out of that and inventory management, does that mean fewer SKUs too, that there's fewer things that you're putting into the stores? And does that translate into items that are not in stock or not?
Yeah. Actually, one of the great outcomes, Becky, is we're actually in stock more often. It's greater reliability. When we have the right inventory in our system. It flows from our DC stores more efficiently, from our stores to the shelf. And we focus on retail fundamentals, which start with making sure when you and Joe come in, the product you're looking for is on the shelf at a great value with a great guest experience. Whether you're in a store or you're using our drive-up lane, which grew by double digits again this year, and we're putting it in your trunk and then bringing you now your favorite Starbucks coffee. So reliability is really important. And when we get inventory right, the entire system flows better.
Meaning what, though? I mean, is that just merchandising, like you pick the right stuff, or is it that you really cut back on the number of things that you're putting out there? Because that's a tricky thing to do, being a merchandiser.
Yeah, and it varies by category. Yeah. So category by category, looking at the right blend of how many items do we want in the assortment? What's the blend of national brands versus own brands? How do we bring newness in? And I think in many categories, we've done that really well. One of the standout categories for us when I think about newness and inspiration has been beauty. And that category just continues to grow. Great national brands, great newness in that category, great discovery. And we're going to take some of those lessons and bring it to other parts of our assortment.
It's already been 10 years. You've been there 10 years.
I have been there for 10 years now, Joe. We've been at this desk quite a few times over the years.
Do you think you do things differently now? I mean, are there things you've learned? And I'm not about the inventory thing. Or are you better now? What have you learned over the 10 years that maybe you would have done differently in the past now?
Well, I think our entire team has learned how important it is to listen to the consumer. And I use that term versus the way we talked about it in the past, talking about listening to our guests. And we certainly value the relationship we have with those guests that love shopping with Target. But I think we've learned we've got to listen to the American consumer, be on trend, understand how things are changing. I mean, in the retail business today, social plays a big role in influencing what people buy. If Becky Quick is wearing a white puffer at Davos and happens to tweet that she found it at Target, the next day I know people are going to be rushing into our stores looking for that product. So we've learned we've got to be really good students of the consumer, constantly follow trends, see what's new and exciting. But I think that's been, for us, foundational.